So let's talk about the deficits, because the CBO came out with its budget projections for the next 10 years. And according to those projections, they expect 1.4 trillion in 2023 and an average of 2 trillion per year from 2024 to 2033, which means the US public debt will rise by 5.2 billion every single day for the next 10 years. I mean, when you hear that projection, what goes to your mind immediately, Preston?
I mean, they were off by what, 500 billion, or no, 500. What was the number? In 3 months, it was twice as high than what their projection was 3 months ago. It was twice as high, right? So what I get out of it is, I think whatever you think you understand about their projection is a fool's errand. If you think you're trying to figure that out, that's a fool's errand.
Yeah.
Because it's just a total lie. I think that when we look at what they're going to be bringing in through just their tax revenues versus what their spending habits are, and rest assured, they have to spend at these levels. They have to acceleratively spend in order to facilitate enough dollars in the world. And so you have that idea combined with just these gross estimates of what they think it's going to be. And so I just look at the numbers and I just roll my eyes and I say, nobody has a clue what it's going to be. Mm-hmm. Because it's running away. And when you plot it and you look at how it's an exponential, it's not a linear in anyone's imagination. You can just look at the chart, you can see it's an exponential, and I don't think that they have any control over any of this. So we'll see. I think spending much time discussing what the level is going to be in 5 years from now is just a total waste of my time and everybody else's time, because I think it's a lie.
Yeah.
Hey, going back to this idea, we were talking about valuation. So when you just take the S&P 500 today, the S&P 500 is at a PE of 21. So what does that mean? Well, if you look at the price and you look at the earnings, the price, you're paying $21 to extract $1 of earnings out of that ratio, 21 to 1, PE of 21 to 1. So when you invert that and you go 1 divided by 21, what you get is a 4.7% return for owning the S&P 500. Okay. And this is just really rough ballpark numbers. 4.7% return. Now let's compare that to the 1-year treasury, which is currently at 5%. And you know what execution risk is associated with that 5%? Nothing. Mm-hmm. Right. So when we look at the S&P 500 and it's priced at 4.7% with tons of execution risk and, whether they can retain their competitive moat for those 500 companies, and you're paying a discount of 0.3% or 30 basis points compared to the 1 year. I'm not talking 10 years or the 30 year, which is even lower. It really kind of paints a picture for somebody who's trying to wrap their head around the insanity that we currently face. And guess what? That 1-year treasury is increasing in yield. It's selling off, which is giving you even a higher yield. So that's the challenge. And that's why it's so confusing for everybody, because they're looking at this and they're saying, well, do I buy that? Or do I buy stocks that have some type of scarcity to them? Because if I buy this 1-year note, it's completely impacted by inflation. There's all sorts of things that are going on. The math is so jacked. And the reason that the math is so jacked is because you're dealing with a unit that is completely manipulated, with governments around the world that continue to step in and just willy-nilly print and hand stuff the money into whoever's hands, whether it's the big banks, which is pretty much where it's all gone. It's gone into the hands of all the big banks. They sprinkled a little bit of UBI over COVID, and people thought that was, crazy. But relatively speaking, the amount that they shoved into the hands of the bankers over the past decade, the amount that they sprinkled into the hands of these people over UBI was literally laughable. It might have seemed like a lot, but it was laughable in contrast to the amount of QE and manipulation that they did sticking it into the hands of the bankers. So just some other ideas and why the math is just so jacked in the current situation that we're facing.
Yeah.
Yeah, and just going back to the CBO projections, they give you their assumptions and they're insane. So to Preston's point, it's tax receipts going up every single year for the next decade. So no recession. We are going to basically have inflation coming back down to 2-ish within a year, 18 months. The average weighted coupon on the debt is going to be 4%. You're still running $1 trillion to $2 trillion deficits for every year for the next 10 years. So as illogical as that might seem at its face value, I think the craziest component is that they're saying all of that incremental debt is going to be funded by the public. So that means a third-party borrower is going to willingly go out there and continue to finance this. And I know you guys are close with Lynn Alden, so hat tip to her where she tweeted this, and then I went and kind of dug up the data from the I think it's the Budget Oversight Committee. But so they're projecting that the percentage of debt held by the public, I think, is going to get up to around 110% within a couple of years. So you hear about debt to GDP exceeding 100%, but in this case, what's held by the public, so not including what's being sterilized by the Fed, is going to increase 100% imminently, go to 110% within a couple of years. The only time that it's ever been remotely this close, I think, was 108% in 1942. Obviously, we had a pretty big reason to be lending the government money and a lot of rebuilding to do, and then had one of the largest surges in labor force participation and productivity on record, which then basically brought that rate back down to 20% in fairly short order. So again, when you audit that math, it's even more laughable.
Jeez.
What's really frustrating, Sam, is like when you look at how they're spending money, right?
Yeah,
where it's going, and then you look at the infrastructure here in the U.S. and how it's falling apart.
It's blowing up.
It makes you want to scream. It makes you want to scream because it's like, okay, so we're going to print billions and send it to this country and that country, and we're going to do all these things, but internally, we're like the capital investment. It's insane. I saw this video on Twitter of like this train kind of coming down this track in Ohio where they had the spill. And I mean, it literally looked like it was out of third world country. And it's like, okay, so we're making these capital investments everywhere else, but we can't make capital investments locally. And it is really frustrating. Yeah.
It's like what you said too. I mean, the tax receipts, Luke Roman just tweeted this. They were down 9.3% year over year in January, bringing them down 7% year over year for the 2023 year to date. And the interest payment alone on the debt is supposed to be over $850 billion in Q4 2022. So the spending, if the spending was aimed at long-term investment to increase productivity, enhancing infrastructure, research and development, that would have a deflationary effect, right? As long as productivity exceeds wage gains, then there's no inflationary impulse. But if the spending is just going to interest payments on existing debt or towards ever-growing entitlement programs, I mean, what's the end game there? It's a spiral.
There is no end game. The end game is hang on to your butts. Yeah, hang on to your butts and buy as much Bitcoin as you can because this is about to get crazy.
Or to James's point, like other hard assets could do well in that period as well too. And James, that's, you guys have the Inflation Beneficiaries Fund. It's been doing really well since its inception. It's returned almost 14% annualized, well outperforming the S&P 500. What's your strategy within that? Because I noticed there's all kinds of things. You mentioned agriculture, land. What's your overall strategy with that fund? Because I just found it really interesting. I think it's an interesting time to launch it. Obviously, you guys have this thesis of longer term inflation. What are some other ways to play that besides, like, as we know, Bitcoin, but other ways?
Yeah, I mean, again, it's things that are finite or somewhat finite in the ability for the supply side to respond. And that's why it's kind of comical in how the Fed is responding and trying to combat inflation, because everything they're doing is trying to reduce inflation by reducing demand. But that's putting a Band-Aid on a patient that needs surgery. Surgery would be, we need more natural gas, we need more oil, we need more fertilizer, we need more arable land, we need a heck of a lot more copper if we're going to electrify the entire planet. And, at this rate, we're going to electrify the entire way up to the moon. But copper mines take 15 years to do a greenfield copper mine and get it up to scale production. So the parallels with Bitcoin are obvious. There's scarcity, and with Bitcoin, obviously there's a complete limit on supply. I mean, supply growth is fixed, and then obviously it's finite after a certain point. But there's parallels there in all of these hard asset markets. The problem with hard assets, and the reason why you've seen capital withdrawn from these businesses, is that they've been bad investments. So energy, copper, agriculture, to a lesser extent, land and infrastructure, most of the commodity complex has been basically underwater since 2005, 2006. So all of these companies were expanding supply. People thought that, remember the BRICS miracle, where China and Russia and India were going to basically spur real growth of 5 to 7% a year forever. So they flooded the market collapsed, and it's been basically a 15, 20-year down cycle. But they are inherently bad businesses, low return on assets, very cyclical profitability. So then what we look at is we try to find capital-light businesses. So how do you get access to those types of assets with business models that have high profit margins, can scale? Ultimately, it's all about, can you grow revenue in nominal terms, so inflation-adjusted terms, where your cost structure doesn't participate in that growth? So things like royalties in gold and iron ore and energy, financial exchanges, where again, they're basically just toll booths on financial activity. And their volume, which drives their revenue, is very highly correlated to nominal GDP growth. So again, it's finding that scarce asset base, and then overlaying the quality business model so you can feel comfortable owning this and not having to worry about a CEO pitching the board, spending $3 billion to go dig a hole in the middle of God knows where, and then destroying your capital returns for the next decade.
Hey, Sam, sorry to backtrack a little bit, but we had brought up some points with the numbers there on how bad the Treasury has estimated their expenses here. So the U.S. Treasury needs to borrow $932 billion just in the first quarter of 2023. This is $349 billion more, which is 60% higher than they thought they would need to borrow last quarter. Just to give you the numbers.
Jeez. I mean, the projections get me too, because we feel like we're entering this decade that is more uncertain. There's more geopolitical tensions. All of this debt problems that we see, and they expect that there won't be a recession, right? In the assumptions, and that there won't be some kind of major conflict. Like, hopefully not, but things are uncertain right now, and it just seems absolutely ludicrous to have those projections and not expect some kind of event that occurs that would require more, debt issuance, and it's just silly.
I got